Welcome to GRE. I'm your host, Keith Weinhold. If you don't invest in real estate, are you really just trading baseball cards? Then I'll focus on what has been consistently one of the most booming states for real estate investing in all of America. I'm coming to you from the Southern Hemisphere today on Get Rich Education. Checkbook IRAs have been ruled illegal by the U.S. tax court, with contribution limits 10 times what traditional and Roth IRAs allow. Get total control of all of your IRA funds without paying the nasty UBIT tax with the retirement plan answer left standing, the EQRP. You can invest your retirement funds in real estate, gold, Bitcoin, and even your own business. This works whether you're a solopreneur or have up to 50 employees. Learn more about getting started. Text EQRP in all caps to 72,000. The annual Spartan Summit is on. I was the kickoff speaker at the last event. This year they are back in person, and the keynote speaker is none other than Shark Tank's Damon John. Learn from industry experts on real estate, tax strategy, lending, and entrepreneurship. You'll also get to tour tangible turnkey income property in growing Alabama markets. It's coming February 16th to 18th in Birmingham, Alabama. Get your ticket or learn more at SpartanInvest.com today.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from Escondido, California to Quito, Ecuador, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. With nearly 4 million listener downloads now, I am back to help you build your wealth for the 381st consecutive week. And for the first time ever, I'm coming to you from the Southern Hemisphere. More on that later. Hey, let's get clear on something. For almost everybody, there are two paths to financial freedom, and debt-free is not one of them. The first way is to own businesses, and the second way is to own real estate, which is really like a business. Those are the two paths to financial freedom. So pick one. Notice that debt-free has nothing to do with it. And I mean nothing to do with it. In fact, both ways, owning businesses or owning real estate, require other people's money, not any sort of debt freedom. In fact, debt-free is often directly detrimental to becoming financially free. It's hurting you because debt-free means that you have zero leverage. Debt-free means that you've got zero scale. And then debt-free means that you've got zero wealth. If you only use your own money, how big could you ever grow this thing? So use debt to control income streams that enhance your quality of life today and simultaneously pay down your loan for you through leverage for tomorrow. And with what's happening in financial markets today, debt-free is the worst business plan that has been in my entire life, and probably yours too. When mortgage rates are still half of the inflation rate, you're profiting 2 to 1 right there with every dollar that you borrow for an income-producing asset. So for almost everybody, there are two paths to financial freedom, and debt-free is not one of them. The first is to own businesses, and the second way is to own real estate, which is really like a business. Those are the two paths of financial freedom, so pick one. And as you compound your cash flows, you will happily take on more and more debt, which probably means that you're continuing to further compound your cash flows. It's about picking that durable vehicle for wealth creation that pays you 5 ways. And really, most things that people consider investment assets, they don't pay you any yield at all. Now, there are creative, inventive ways to make some of these vehicles cash flow, but this is not what they're designed to do, if you can even do it at all with non-dividend paying stocks or gold or mutual funds or most anything that a retirement plan invests in. And then bond yields, they're just a fraction of inflation. And you know what? Most things that people consider investments are like baseball cards. Yeah, really. They're like baseball or football cards. Your Ken Griffey Jr. rookie card, it's kind of cool to have and look at, but it doesn't pay you every month, just like most other things that people consider investments don't pay you every month. Your Tom Brady refractor card or whatever, you're hoping to buy it lower and sell it higher because that's all you got. That's the only plan for profitability, just one way, not five. So we talk about playing a game worth winning, like real estate in the 5 ways. I like to say, do the right thing and then do things right. Real estate investing is doing that right thing. You know what the late Stephen Covey said about this? And this is such an elegant way of saying it. To paraphrase, imagine spending your life climbing the ladder of what you think is financial success, only to get to the top and find out that the ladder was leaning against the wrong wall. Yeah, that's what a lot of people think when they're age 64 or 71 and they're ready to hang it up. And only then do they get access to an income stream that they save for. How much life do they have left? So the lesson is own things that pay you to own them while you own them, preferably that pay you monthly. Otherwise, are you just investing in baseball cards? Sure, I guess that vintage 1989 Upper Deck Ken Griffey Jr. card looks pretty cool though, right? Hey, well, you're going to find the rest of today's show really helpful. I have been keeping in touch with a very experienced real estate provider where, by way of her expertise and connections, actually has plenty of investment property inventory right now. Yeah, here at a time when it's difficult to have any, as the supply of available U.S. homes today is about 1/3 of what it was just 5 years ago. And that's using Realtor.com statistics of the current average listing count. With the geographic market that we're talking about today, I think it's easy to make the case that housing in this state is undervalued and it's underpriced and it's serving a population that's still underhoused. And this is all in just about the most vibrant, booming place in the nation today. In fact, even about 15 years ago in 2008, the market that we're talking about today stayed resilient. In fact, it's probably the most resilient market in all of America. And I bought my first ever out-of-state income property in this market that we're talking about today. I did that back in 2012. On top of that, just listen to how this provider customizes the property management and tenants and properties to their market. And it makes for this all conducive and easy to approach for out-of-state investors like you, or if you live in this state, for you as well. That's coming up shortly. Next week on the show, if all goes as planned, we're going to be talking about teenage financial independence, which almost sounds like an oxymoron or antithetical or hyperbolic or an antipode, if you will. Before we get into today's core real estate investing content, I've got a cool geography moment for you. If we look at world urban centers that have more than 1 million inhabitants, Denver is the highest city in my home nation of the United States at 5,280 feet. That's why they call it the Mile High City. Today, I am in a city larger than Denver, and I am almost twice the elevation of Denver. I am at 9,350 feet right now. Where am I? I already told you I'm in the Southern Hemisphere, and that is Quito, Ecuador. Yes, I'm in this, it's really about a Colorado-sized nation here in Ecuador on the South American continent. Yeah, so resultantly, the temperatures don't get too warm in Quito. A high of about 70 degrees Fahrenheit here in the Andes Mountains is what you can expect. Yes, a capital city of about 2 million inhabitants in the area. It's over 9,000 feet in elevation. And I haven't been here that long. This Ecuador trip will have me spend about 3 days here in Quito, and then 3 days east of here in the Amazon jungle. That ought to be really cool. Then a pretty substantial side flight of perhaps 800 miles west to get out to Ecuador's Galapagos Islands. Yeah, where Charles Darwin did his work, and we'll see all the giant tortoises and all the wildlife for 3 days. And then wrapping the trip up back on the mainland for about 3 more days in Ecuador's largest city of Guayaquil. See, when you invest in real assets that pay you income, you can enjoy the best things in life and the best places in life when you're actually young enough to enjoy it? I mean, sheesh, why would you want to do life any other way? Hey, you'd just be trading baseball cards all your life. Now, I don't talk too much about personal stuff on the show here. This is a real estate investing show. But if you want to see more of my trip or more of the personal side of me, there are two ways to do that, I guess. My personal Instagram handle is pretty easy to remember. It is simply Keith Weinhold. And then secondly, our YouTube channel, which is simply Get Rich Education YouTube, that is predominantly real estate investing, but I might put an Ecuador video in there as seen through a real estate investor lens. If you haven't yet, definitely check out our YouTube channel because that feed, that content, that is different than what you get here on the audio-only podcast. It's not just the videos of our podcast interviews. It is all new content over there. And recent videos on the Get Rich Education YouTube channel have included my take on where physical fitness intersects with investing. And I talk about my age and my sleep patterns and all sorts of things. Also, a video on the pros and cons of gated communities, and you get my strong opinion on whether I like gated communities or not. There's a video with more on the rent to value ratio. I wanted to make that visual for you over there. And then there's another recent video of me on the 10 worst pieces of investing advice that you commonly hear and why they are bad advice. And there's more over there that we don't get time to cover here on the audio-only podcast. And a lot of these videos are just me talking, so they're solo, me to you. A lot of them are 10 to 15 minutes in length. And I guess that, well, you get a really good look at me over there.
You know, I hear the camera adds 10 pounds. Looks like you've eaten 5 cameras.
Well, wait, was that Steve Carell? You know, the guy from The Office? It sounded like his voice. No, I don't think that's the case, but hey, you can be the judge over there on YouTube. I am 5'11" and weigh 180 pounds. Though I'm visiting Quito, Ecuador today, back in the United States, there is one special investment state where I've invested myself. We're going to talk about that state and the professional that's been a long-time provider of the property and the management next. I'm Keith Weinhold. More straight ahead, check out our YouTube channel. It's called Get Rich Education. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074.
This is Richard Duncan, publisher of Macro Watch. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I'd like to welcome in the principal with a longtime provider of investment property in one of the consistently fastest growing places in the nation, and that is Texas. Welcome back to the show, Leah Slaughter.
Thank you so much for having me again.
Leah, you have such an expansive geography there. You really serve areas almost statewide throughout Texas, except for parts in the northern panhandle and those portions out in the far west toward El Paso. But why don't you just give us an overview of the Texas market overall before we winnow down and get smaller?
Of course, Texas is very strong, and there's a lot of reasons for that. We fared very well through the last couple of years. And there's a lot to thank for that. If anything, this whole COVID situation has done amazing things to intensify the growth already happening in Texas. Front and center is the business-centered mindset. There's so many things that have happened, like the Texas Enterprise Fund, to generate these businesses wanting to come here. But you look at the no state income tax, the relatively low cost of living for pretty much everywhere except for Austin, massive metropolitans that have diverse employment options. You're not really centered in just one core type of employment. It's just really the trifecta of everything that you want for a market to grow. And you look at the lockdowns and everything that happened over the course of the last 2 years in certain states, and Texas shines. We are at our core for business-centered type decisions. And so our ability to open up and allow businesses to operate and do all sorts of things to support our market has really just come tenfold back, because now you've got all these businesses moving here, which was already happening. You know, before COVID, we were seeing 545 people a day moving here.
Gosh.
And it's just crazy. And, you know, every day I feel like there's a new apartment complex, a new highway being widened. And it's great, right? It's that double-edged sword, because now I have a lot more traffic, but on the same token, it's been phenomenal for just the market as a whole. What people have found and what we're seeing is that people don't necessarily have to live where they work, because there's still a lot of work from home type things happening. But it's also about when the employers are moving here, all of the companies they work are now moving here. Their people move here. They get to live for less. They make the same or more. And so they live a much better, healthier, happier lifestyle. And then, of course, Texas allows that kind of movement away from that real dense housing. And so you come to Texas, you get the nice backyard, you get the big house, all the stuff Texas is known for. And instead of paying, you know, $1.5 million in California, you're paying $250,000, $300,000 here. And so it really has just allowed us to have this astronomical growth. And that has been just kind of the trend for the last 3-4 years.
Yes, like you say, still, even with the run-up in prices everywhere, buying a home in Texas is pretty much what could be paid for with the amount that would constitute perhaps only a 20 or 25% down payment on a home in coastal California. I know there that you've really focused on more of the bustling, faster growing area of Texas. And that is generally that northeast quadrant, a big area which includes Dallas-Fort Worth and more. So tell us more about focusing on DFW and those surrounding environs in the northeastern quadrant of Texas.
The thing that's so incredible about Northeast Texas is it really has the best of everything. And so what I mean by that is we are the third or fourth largest metro in the United States. And when you look at the other major markets that compare, New York, Chicago, LA, there's really no comparison, right? So DFW, your average home price is still under about $300,000. And so we look at these other markets where your average home price is $800,000, $900,000, $1 million. It's a completely different style of living, because there's this affordability piece that still exists in DFW that doesn't exist in every other market that compares. And at the end of the day, that is really what sets us apart. And one of the questions I get asked a lot, and of course, you know, we have no crystal ball, but do you think property values are going to keep rising? And my answer is, well, there's no option for it not to. Every other market that we compare to is triple where we are. So like as of January of last year, the average price in Dallas was about $244,000. In Fort Worth, it was a little bit less. I think it was like $227,000. So if you look at that compared to the other cities that compare, it really is no comparison at all. DFW is a pretty big area. It's about 11 counties, and we're at about 7.6 million people. They're estimating this year we're going to hit about 8 million people. We have the fourth largest concentration of Fortune 500 companies. Our GDP is the 9th largest economy in the world in Texas. And you look at DFW just by itself, we're like the 20th or 19th largest. So the market size we're talking about is massive, and yet we're still priced like a small market. So we're so undervalued at this point. I don't see any path where values don't keep going up. Most of our suburbs saw price increases 20, 25, 30%. And my concern with people saying that that's going to stop is that they're going to be caught off guard when it keeps happening. Now, the interesting thing about DFW and our model specifically is we focus and hyper-focus on the suburbs. And the great thing about the suburbs is that they're a lot cheaper. But the benefit of the suburbs is that's where literally all the growth is happening. Now, let me explain what I mean by that. Most of your employers that are relocating here are going into the suburbs. Virtually every Fortune 500 company that has come lately has gone into our suburbs. But the difference between the suburbs and the main city is that the suburbs are actually growing in size. Now, this is where it gets really interesting. So if you look at like Dallas County, the main heart of the city where we don't operate, they had almost net zero population gain last year. But you look at, it's real strange, right? But it's because our market is so unique. And I'll explain a little bit why this happens in a moment. But you look at the counties where we're operating and really where all the growth is happening, they grew 30%. So there is a massive discrepancy between the inner city growth, which we avoid, and the suburbs. And the reason being is the suburbs are where everybody wants to be. Going back to the big, nice houses, the nice yards, the cost affordability of the homes, nicer, newer schools, shopping everywhere. You will never see the amount of dense shopping that you will see in North Texas. And that's because people have more expendable income left over. And when you look at the employment that's coming into Texas and DFW specifically, most of those jobs are high-tech jobs. One of the areas we work, Sherman-Denison, that's Grayson County. They have so much growth. Texas Instruments, Tyson Foods, major employers. And the vast majority of the jobs adding are six-figure jobs. Now imagine that in a cost living basis like what I've explained in DFW, and that is why our suburbs are so desirable. But the bigger piece is we don't have the traffic problems of your other large MSAs, Chicago, LA, and New York. All of those had net population loss from 2019 to 2020, every single one of them. So in 2020, Dallas County added like just under 300 people. But DFW as a whole grew 120,000 people. So that means almost every single one of them went to the burbs.
Yeah, that is remarkable. And you mentioned the word undervaluation. I think it's easy to evaluate this market as an undervalued one. And really what that gives real estate investors is a factor of safety. I'd say safety isn't absolutely my favorite word in the investing world, but it is sort of like a safety net underneath one. And you do talk about the outlying areas, and that's where a lot of the growth is. When I had you on the show last year, we talked about how the numbers don't really work that well toward the center of Dallas anyway. So it's interesting that the growth isn't there either. Both the growth and the way the numbers work with the ratio of rent income to purchase price tend to be better in some of those outlying areas. You mentioned Denison Place substantially north of Dallas, up toward the Oklahoma border. So tell us more about why you do choose the particular suburban areas that you do, Leah.
There's a lot of reasons. One of the things I talk about a lot is the housing shortage. And anyone who turns on the news right now knows that we are far behind in builds beyond where we should be. So if you look at the numbers and you just talk about statistics of what's been happening, if you look at home builds in every other decade, you look at, and you can go online and you can pull up these charts, or you can always go to our YouTube and go see the class I've taught on this. In the millions, there's so many home starts that have started. And what we found was from 2010 to 2019, it plummeted. There's a lot of reasons for that, right? Number one, we came out of the crash. A lot of builders went out of business. They didn't have the ability and easy access to capital that they did. And then, of course, prices went up significantly where lot values and pricing went up, so it was less affordable to build. But really, the big problem and what has affected our market significantly is filling the need with Class A apartments. So like one area alone, we had 40,000 home shortage above what we needed for relocations. Now, keep in mind that we have all these people moving here. They have to be housed somewhere. And if you look across the U.S. as a whole, only 1 in 5 homes was built in the last 20 years. It's a pretty staggering figure when you're dealing with a market where you have doubled in size. And so we look at the home starts and they're plummeted. Now, we're starting to recoup a little bit now, but then COVID happened. And so we have this massive housing shortage. They've filled the need with all these apartments, and these apartments cost more than the rent houses were doing because they make them amenity dense and they pack them with these ridiculous things. I mean, you've got workout centers and complex pools. And I mean, it's crazy what they're building in these apartments, but they charge a fortune. And people that are moving here to have space don't want apartments. They want homes. The builders have shut their model homes across a lot of the Metroplex because they're on 2-year wait lists to even begin construction. So our housing deficit is astronomical. The migration here is hurting us, but we were already in a deficit before it went to this level. And that is because there just wasn't new construction happening in the last decade. And then COVID hit right when it started to ramp up. So we look at these suburbs. If you're a developer and you're building apartments, are you going to want to go in the main city where you're going to be able to charge a fortune? Or are you going to go into these little suburbs where prices were in the $100,000 range? Well, you're going to choose to go in the city. It's easier to find vendors. You're going to have a bigger profit margin. So these suburbs that we work were virtually completely left out. And so when you look at the average age of home prior to what we started with all these new construction developments and infill, there was nothing. And even now, these builders are going into Frisco and Plano because they can charge. I walked a property the other day, tiny lot, quarter acre or less, 6,000 and some change square foot house, $4 million. $4 million.
That's astounding. And for people that aren't familiar with the geography, Frisco and Plano are somewhat closer to DFW than Denison.
Yeah, so you're talking like a 30-minute difference here. But with our highway system and our lack of extreme traffic, you can live anywhere and travel on our HOV toll lanes and all these things. And it's so different from the other markets, but we grow outward. And so if you're a builder and you can go 20 or 30 minutes further, and instead of charging $500,000 or $600,000 for that house, you can charge $4 million, where are you going to go? And so these suburbs have been left out. And so the rental need up there is so strong. Now, the other thing is you have to remember home ownership is at 50-year lows. So in our market specifically, almost 50% of our people are renters, not because they can't buy, but because we are non-committal, especially the younger generations. And if you look at the statistics of who's moving here, the vast majority of who's moving to the suburbs are young working professionals. They don't want to own homes. They love renting. That's why we have that 50% ratio. Now, Tarrant County, the Fort Worth side, they're closer to 40% renters, but the Dallas County and North side is closer to 50%. There's nowhere near enough properties to fill that need. So that's why they filled it with apartments. There's just so many reasons why the suburb play is the wisest. And again, there's no crystal ball, there's no guarantees. But am I going to pick a market that's undervalued, underhoused, and now underpriced in these suburbs that can't fill the need? Absolutely. So my portfolio is 100% in suburbs, to put it into perspective.
Yes, that makes a lot of sense. You have to go where the demand is. You have to go where the numbers work. How has it been with inventory sourcing? Of course, we know one of the trends during the pandemic has been the supply shortages. Back earlier in the pandemic, lumber spiked, for example, and throughout the pandemic, the United States has seen shortages of everything from drywall to cabinet hardware and so on. And just a couple of weeks ago, the Wall Street Journal was reporting that garage door shortages and gutter shortages are a problem. So can you talk to me about some of the industry trends that you see there, especially with the supply shortage perspective?
I'll tell you that build pricing has definitely gone up. We are down from where it got up to. So if you look in the middle of COVID, when things got so bad after they were initially shut down, there was definitely a higher cost for a lot of what was happening. But our purchase contracts are not cost plus, meaning that if the builder has extra fees, they can't pass that back on to our clients. Wow. And so everything that was locked in during that period of time, the builders did make less money, no doubt, but that didn't pass on to the consumer. Now, what I saw personally on my rehab properties was prices did go. The nice thing is we're such a large market and so much comes from our ports. We tended to have better supplyability than a lot of your northern areas. And so that was really beneficial. And also, you have to remember these builders that are building lots at the same time, they're not ordering the day they need it. They're ordering in advance. Now, I will tell you, there are parts of the country that have really struggled with supply. And that certainly is something that we all just kind of have to work around. I'll give you an example. The days of having an appliance delivered next day kind of disappeared. So when we were doing a property or building, we would just order the appliances 60 days out because you don't need them day one when you break ground. You know when you're going to need them. So we just changed the strategy of how we timed things. Now, most of that we're over. DFW, again, we're part of the supply hub and distribution channels of where things physically go on 18-wheelers. So we really aren't having a ton of that problem. But I do know smaller markets are struggling for sure, not to the extent they were, but it does still happen right now.
So let's talk about what you're able to offer. We're a show of listeners that's interested in investing in income property in the path of progress. So talk to us about where the activity is now, Leah.
We cover, as you mentioned, a large territory under our property management division. So kind of going back to basics, we are a real estate property management and investment firm. We represent about 1,400 investors. We manage over 2,000 properties, and almost 20% of those properties and units belong to me. So I'm right alongside our customers and what they're doing with their model. Yeah, we love it. And we hyper focus on the suburbs all around the core of Dallas-Fort Worth. So the inner cities, you can draw a circle, cross them out. We don't deal in those areas. What we do is deal everywhere around there. And those areas are phenomenal. They've really done well. Most of those areas saw at least 20% growth last year. You're dealing in new construction predominantly or recent builds, so lower repair costs. And inventory is always fleeting. So it's really important that you build the relationships and you have exclusive off-market opportunities. And that is exactly what we've done. We've done this model for almost 16 years, and we have a fantastic group of people that we work with and a fantastic group of people that work for us. Everything's under one roof, and so it's very streamlined and symbiotic, and we make it very easy for our builders and for our contacts, which then in turn makes it easy for the investors, and so everybody's happy. So we have a myriad of on-market property, off-market exclusive property, investors that are liquidating or selling. It could be that maybe they're retiring or they're going through a divorce or who knows. And so we always have property available. So inventory really hasn't been an issue for us. No one has as much inventory as they did 3 years ago, but we have plenty. We have an investor portal that you can go on and view the available properties, the returns, the specifics on the cities, all the details that you need. We do property flyer blasts. We have all sorts of options. And then, of course, we know what you're looking for as one of our customers, so we can send you properties that fit your needs. I would say on any given day, we blast between 3 to 6 properties. And then on our portal, we have dozens at a time. So inventory is tighter than it was, but we have plenty.
That's a remarkable statement to make, that you always have inventory available. That says an awful lot about your planning and your ability to source labor, materials, and so on. So with what you have available now, and from what you can best foresee over the next few months, we're talking about suburban properties in these outlying areas in the northeastern quadrant of Texas. So we're talking about single-family rental homes up to duplexes, fourplexes, larger, or what are we talking about here?
So the vast majority of what we deal in is single family homes, either new construction or recent construction. And purchase prices go anywhere from, say, $160,000 up to $225,000. And there's a large myriad of property. We also deal in duplexes and fourplexes, both new and pre-owned. We do tend to get a lot of new construction duplexes, but some of these cities are trying to crack down on that lot zoning. So we don't see as many as we did, say, 4 or 5 years ago. To kind of give you an idea of inventory upcoming, for example, I have one builder who's giving us 26 exclusive off-market properties just in the next 90 days. And that's just one of our builders. So again, large volume means large reputation, means easy access. So it's all about what you build, right? And we are very much mom and pop. We're corporate sized, but we are mom and pop. My husband and I started the company. We were 18 and 19. This is all we've ever done. And we've built a business around our investment model. And so it really is, as I mentioned earlier, very symbiotic for everybody involved.
Those are very affordable price points. When you talk about the single family rental, $160K to $225K or something like that. And interestingly, there in Texas, you talked about the no state income tax, but of course there is property tax to pay. And you have such an interesting property tax mitigation strategy there. Tell us about that.
One of the benefits of new construction is, depending on when the property is built, we assess values on January 1st. So if your home broke ground, say January 15th or 20th, and it's finished in the end of April, you're assessed typically at lot value for that year, which that property tax bill may be $50 a month. And so that entire first year of ownership, you're saving, say, $250, $300 a month. That's a huge difference on cash flow. And then immediately once you have your first assessment, generally they don't get anywhere near what you paid. We typically see them get to about 60 to 80%, sometimes 70% is kind of your average.
Okay.
And it takes time to get up to full value. But once it gets to full value, generally you're already either selling 1031ing under our model or your value's gone even higher. And then the moment that it hits that first assessment, the first true assessment at value of property, we recommend you go to our tax people who go and fight that property tax value for you. It costs you nothing unless they win, and it's just a percentage of your savings. So if they can't get your value down, it doesn't cost you anything. But I personally put all of my properties under that program the moment that I close, and we see huge success in keeping our property tax values down. Most of my pre-owned portfolio has barely gone up at all in the last 4 years, despite the massive increases in property taxes and based on the valuations going up. And that's because we're aggressive with fighting them. They will go up significantly if you don't fight them. And so again, it's a no loss to you. You only pay if you win, and it comes off of your savings. And I think that percentage is like 25 or 30%. So it's not significant either.
Okay, so just to review, if someone's buying a new construction, call it single family rental property, oftentimes it might be 2+ years until that property tax assessment really catches up with the valuation of that property that you had paid for it 2 years previously.
Yes, so mine have not hit even in 2 years, but it just depends on where you are, all that minute things, each one's case by case. But I haven't had any of mine catch up in 2 years on my new properties. They're still way behind. Our property tax values tend to be far below value anyway, so that's not really surprising. The other benefit and the other reason we love dealing with infill lots is all of your neighbors they're comparing you against are either remodeled, still need to be torn down, or they're already rebuilt.
Great point.
So when you're in the middle of a neighborhood and you're in the middle of all brand new identical homes, it's really easy to value. When you're in the middle of a mix of a little bit of everything, They have a really hard time valuing. I have properties in Collin County that I own in Blue Ridge that are still assessed under $100,000 and they're worth $200,000. And I've owned those for 3 years. And it's merely because they don't know. They look at age, they look at what's around you, and they have to do kind of an average. They don't have time to deep delve into every property. So generally you fare a lot better on property tax savings when you deal in infill property. And that extra return can be up to 5-10% a year. It's significant.
If you want to get started with property, go to gremarketplace.com/Texas. There are a lot of good resources that have been put for you there with this provider, including a video walkthrough on a property on Baker Street in Denison, Texas. You see Andrea interviewing the property management there and learning about how you can connect with property. You can do that at gremarketplace.com/Texas. There, you are so conscientious about what investors need and what they don't want. And one thing that you do there is, now you do have a leasing fee that's less than a full month's rent, and your property management fees are remarkably low. Tell us about that.
As I mentioned, we're a very large firm, and most companies, I feel, overcharge for property management. They nickel and dime, and they charge a monthly percentage that is just ridiculous, especially on these rent rates. So our fee is and has remained 6.5%, and that's an inclusive rate. It's really a one-stop shop for you. And we include quarterly visits at all of our properties.
Great.
And what's really important about that is we're checking on the tenant, we're checking on the property, making sure it's in tip-top shape. And that way we do what's called a 2-month re-renting period. So the last 60 days of any lease, once you or the tenant gives notice that there's going to be a vacate date in 60 days, we put it up for rent. We put a lockbox on the door and our agents start showing the property. And with this, it's vacancy mitigation strategies that keep your returns higher. We have in-house maintenance and repairs. So instead of having to pay these ridiculous third-party prices right now, because the market's so crazy everywhere, these vendors can kind of charge whatever they want to charge. So to combat that, we brought everything in-house. So unless you have a major licensed trade need, like replacing an HVAC system or a water heater, it's all done in-house with our handymen. In addition to that, we have all of our evictions and collections in-house, which is streamlined and extremely easy in our state. So it's really a one-stop shop for you. And when you look at our pro formas on the properties we send you, we calculate all of this for you. We actually break down even that leasing fee to a monthly average and take it out of the monthly profit so that you can get a very clear picture of what you're looking at. We try to be as conservative as possible.
You integrate processes so well to make it easier for that investor. And I know one thing that puts investors at ease with that tenant placement is that you do have a 4-month tenant guarantee as well. Tell us about that.
We do. So what we found was that if a tenant was going to default, which isn't real common, but if they were going to, it's generally because they under budget the cost of moving. And so if a tenant defaults, it generally is going to happen relatively early into that tenancy. The minute they get into that new rent rate, they have all these expenses with the move, utility setup, et cetera. If they're going to struggle, that's typically when it does happen. So if they do default in the first 4 months, we will replace the tenant for free. And so that means you're not paying another leasing commission. You're not paying those fees. We take care of it for you. And one other thing that we do offer is an eviction cost coverage plan where you can pay a small monthly fee. And if your tenant does go delinquent and have to be evicted, any of those types of expenses, we take care of all of that for you. That's something that some investors do love to add into the contract. That way they know they don't have to worry about kind of unexpected eviction expenses as well.
Yeah, that is great to learn and have peace of mind. And your system is so conducive to working with 1031 exchanges like you had touched on earlier. That aligns with my philosophy because typically you have equity buildup and the return from equity itself isn't anything. That wears down your return. And oftentimes after just a few years, it's best to not get emotional about that property you own and to trade up for either a larger property or trade up one property for two properties with that 1031 tax deferred exchange. Are there any last things that one should know about in income property investing in Texas?
The biggest thing that I would tell you is our model is unique. And we really built the model around the market that we were in. So many people, they build a model and then they try to put it everywhere. And the laws are different. The returns are different. The clientele is different. Everything varies. Our market is so unique. And so the model has to be unique too. And so when you come to us, we're going to look at your situation, where your properties are located. Every time that lease is up for renewal, we're running the numbers. We're telling you what the market's doing for rent and for sale. We're helping guide you down that path. Every year you own a property and that value goes up, the rent goes up at a lower rate of return. And so there's this disparagement in the income where your return actually drops every year. Taxes go up, insurance goes up, the rent doesn't go up as much as the value, so those things increase. But the biggest mistake I see investors make is that you calculate your return based on what you paid, not based on what it's worth. And all of that sitting equity goes into your return because that's cash sitting there.
Right.
So we look at that every single year. We recommend the 1031 when it's time so that you can go back into two cheaper properties for the price of just that one was. And the biggest thing I'll leave you with is they're still projecting close to 20% increases this year. Say it's 10% over the next 2 years. Buy in our market, you can double every 2 years. There's not a lot of places where you can say that. No crystal ball, but is that what we all expect? And is that what we've all been doing? Absolutely.
And there are available properties if you heard that. So this may very well be the place where you can scoop up a bundle of properties in a Texas market that just does not appear to be letting down at all. Get started at gremarketplace.com/Texas. It's been a great chat. Thanks so much for coming on to the show.
Thank you. You too.
Yeah, a really, I'll call it well-integrated investment model and solution for you here in such a thriving Texas market. And they've really built a model around the market that they're in providing a product where residents want to live in the suburbs. And starting with what happened in the world 2 years ago, seems like everyone wants a yard. Everyone wants some space. You've really got to love how they're so proactive with handling tax assessments. This is a resource that's really actionable for you. So if it fits, get started. Take a look at a number of sample properties, get a video property tour, see our operations lead, Andrea's interview with the property management there and more. You might want to get started with not just one, but a bundle of properties if you can do it. That is all available for you at gremarketplace.com/Texas. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.